Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to go through kind of my strategy on a great question that what I found in the comments section. And so I'm going to answer that question in regards to my overall investment strategy, and some of the things that I say and some of the things that I do can sometimes not jive. And so I'm just going to break that down for you guys and give you kind of my strategy overall when it comes to investing and so on and so forth. But before we get into that, of course, we're going to give you an update on the portfolio. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So today the portfolio closed out at $11,844.57. We are up $46.85, up 0.4%. For the 1 week, we are down $12.48. Down 0.11%. For the 1 month, we are down $161.70, down 1.35%. For 3 months, we're up $161.63, up 1.38%. For the 1 year, we're up $1,519.85, up 14.72%. And for the all, we're up $2,139.57, up 22.05%. We currently have $47.72 in the cash account with $100 that is going to be going in there. And so that is the portfolio. But the question that I was asked, which is a great question, in my honest opinion, is from Lex. And he asked me to make a video on why I invest in VFV. He was under the impression in my previous videos that I'm against ETFs / indexes / diversifying. And most investors would say that the S&P 500 is very globally diversified due to the multinational business nature of the companies within the S&P 500, despite them being listed in the USA, as well as a broad market and broad industry type of fund. Please explain or maybe describe the strategy in a video. Thanks. So, awesome question. First off, I just want to say that I love questions like this. I love questions that question everything that I do when it comes to investing. And I'm just going to talk about that in general. Do I like ETFs? Yes and no. I did make a video way back in regards to why I don't invest in ETFs. And I should have been more specific on what I meant by that. When I'm investing in an index fund or an index ETF, which is stated in the question, VFV, which is also in the portfolio, as you can see here, we are currently up. Today's return was 1.66%, up $6.12, and a total return of 20 cents since starting that position in this portfolio. Why invest in VFV? Because VFV, being an index ETF in the S&P 500, is like the backbone of my investing. It has the 500 companies in there, and it's not that I'm against ETFs. There's just certain ones, specific types, things that I'm against when it comes to ETFs. And it's not for everybody. It's honestly just my opinion and the way I invest. The greatest thing about investing is that you can invest in any way you want. There's no right or wrong way to do it. And we'll talk about diversification as well again. So VFV is like the backbone of my portfolio or of all my investing. And then from there, as I continually invest in that, that's just my kind of safety net. I feel like I have good confidence in the board that makes up the S&P 500, and it's good index, to be honest with you. Average rate of return anywhere from 8 to 10% since inception, and has very well-known companies in there. If we head over to VFV and we look at the characteristics of VFV, so head over here, you can see the majority of it is in large cap companies at 78%, medium to large 4, close to 5. Medium 14.2, and small 2.55, and 0.04 for those small cap companies. 100% of it is based in North America. However, Lex, you are completely right. I think it's Lex or Les. You're completely right. They are multinational companies which generate amazing cash flow for these companies, as we know. The other thing is that 28% diversification, it is broken down fairly nicely. The only thing is I'm not invested in energy other than in VFV. I don't have a lot of real estate or REITs. That's what real estate stands for at 2.7%, and utilities, not really in there, and 2.6 for materials. I'm a big fan of communication services, so big fan of those. Big fan of financials. Consumer discretionaries, somewhat there. Healthcare, don't know too much about, and technology at 28%. Okay, compare this to like another ETF. So let's say Bitcoin. Here's my strategy when it comes to Bitcoin. This is a ProShares Bitcoin strategy ETF. This focuses strictly on capital appreciation. However, because I have the ability to purchase cryptocurrency anyways, I don't know a lot about it. I'm going to throw some money directly into cryptocurrency. I'm not going to go and find an ETF to boost up or attempt to boost up my returns in my investment portfolio. I'm just going to go directly to the source. That's just how I feel around crypto. The reason I threw that in there is because there's ETFs around there, and I'm sure there's lots of people who are in the investing world, but not in the crypto world, and want some exposure, and their way of exposing themselves to that industry or that sector is through an ETF. I don't like that strategy, to be honest with you. And again, this is just my opinion. I'd rather just go invest in crypto. I just have a little bit of crypto. I don't have a lot just because I don't know much about it, but I consistently have funds in there in crypto, if that makes sense. Okay. Next thing is, let's look at the ETF that BMO has in Equal Weight Bank Index, which is ZEB. This is an ETF that pays a 3.67% yield. And if we break it down, sorry, I'll go to the right one. If we go to the holdings, this only has 7 holdings. It has all the banks that I like except for one, which is National Bank of Canada. When it comes to ETFs like this, where people are like, oh, you're so invested heavily in the banks, I don't really care. I like the financials, but I just rather not have National Bank in my portfolio. So what am I going to do? I'm going to go and purchase these stocks individually because it's feasible for me. Everyone's situation is different, and I don't have to pay an expense ratio, of course. Now, an expense ratio in this one is pretty small. I mean, the management expense ratio is 0.28%. But if I can buy for free the stock itself and hold it for free, then I'm going to go that route just to save, the 0.28%. I don't have a problem with paying that. It's not a big deal. It's not going to make a big difference in my life, but long term, sure, it might. So again, like I said, because it only has 7 holdings and I'm not a fan of National Bank, I'm going to purchase all these other ones. I have this, but in another portfolio. I'm going to invest in those because I feasibly can, right? I don't see the point for myself to invest strictly just in the ETF in banks because there's just not enough holdings. And I just feel like, you know what? I think I can probably get a better return based on that. And I can. The thing is, if we go to trackyourdividends.com, if we look at the return on this, you can see that the annualized distribution yield, words are hard these days, is 3.67%. If I head over to trackyourdividends.com, and let's just go to Bank of Montreal, dividend yield is 3.68. Yield on cost for us is 5.58%. I'm making more on this one alone, on BMO alone, than I would be if I were to invest strictly in an ETF. So hopefully that makes a little bit of sense. Okay. The next thing is, with VFV having such a small portion in energy, because energy is kind of the talk these days, at 3.9%. I don't know how these companies operate. I'm not sure how they generate income, of course, or cash flow. I've never really looked at their financials. I've really never went deep into the energy sector because I just have no interest. And so for people that have energy stocks, I mean, you look at, here's one that I pulled out, iShares, S&P TSX, Capped Energy Index ETF, ticker symbol is XEG. The total return on this over a 10-year period is 0.94%. Let's just go with that. 14 on a 5-year. 14% on a 5-year. Let's use that. This one, 5.13. I'd rather take that out and just not have it. So I'll just do my best to dilute the position in VFV with owning more shares of another thing, let's say in technology, Apple. I do have a little bit of Apple, and I know all these companies. I have a little bit in Tesla. I will soon be making a move on Google post split, just because it's more feasible. And I'll just dilute the energy allocation in this portfolio in this ETF. Okay. And so that's why I pick VFV, because it's a good backbone for me. It's a good kind of, not a guarantee, because no investment is a guarantee. But when I look at this, I'd rather not invest in ETF or not energy sector, whatnot. And I'd rather not invest in energy. So that's kind of out of the question. The thing is, in an energy ETF, I'm just not interested in the companies that are here. I'm not interested in Suncor, Synovus, which I know these companies exist. I'm not interested in ARC Exploration Resources. I know how the company operates. I'm not interested in Vermilion. I know what company that is. And the only reason I know those companies is because I used to work in that industry back when I was like 17, 18. And it's just, I had a glimpse into what it looks like to do oil and gas exploration. And so I'm just not a fan. Just not a fan. And some people aren't, right? So that being said, VFV is kind of like that backbone for me. And then I can go and choose individual stocks, like in this portfolio, because I'm a fan of financials. I can just go and purchase them, beef that up, because these positions are not actually in VFV. And knowing the Canadian financial system being the biggest sector in Canada and making up, I think it's like 35% of the TSX 60, I'm confident that that's where the returns are going to be. And so that's why I don't purchase any other ETF other than VFV, being the S&P 500 index ETF. Diversification is there. The only diversification I, to be honest, really want is in North America, typically in the US, giving the track record. And of course, past performance does not dictate future performance. But I do like the fact that year over year, it does perform, except for maybe this year, but we're only 4 months into this year. We'll see how that goes. And then having a very strong region like Canada when it comes to their financial sector, of course I'm going to invest in those. And of course I'm not going to go strictly into an ETF because there's one position there that I don't want. You can see in that ETF for the bank equal index ETF, National Bank was in there holding like a 15 to 16%. I don't want it to hold 15 to 16%. So I'm just going to go and purchase the positions individually. And if you notice, that ETF did not have some of the financial companies that I like. For example, Manulife Financial Corporation, which is here. Okay. And so VFV is the only ETF that I have. Diversification, I'm not against diversification. I'm just against people diversifying for the sake of diversifying. That's the difference. I'm not against it. I could use a little bit more diversification, but that's what VFV is there for. I'd rather be heavily invested in certain sectors that I'm confident in than have a sector that I'm not confident in, but still have a position in. It just doesn't make sense. I'd rather not have that position at all and use that capital in a position that I'm confident in to think that I might be able to capitalize on my returns and maximize my returns. Now, I'm not an investor who is like a know-it-all. I'm not a fortune teller. Good old adage, I don't have a crystal ball telling me what to invest in, but it gives me that backbone. It gives me a baseline to work with, and then I can build on top of that and have confidence in picking single positions in stocks and understanding that, there is risk in that, but it's calculated risk because I still have VFV as a backbone. I can take more of a calculated risk with these other positions, these single positions, and they all pay dividends. And so I can use that dividend to reinvest into those positions. And eventually the dividends will get so large that I don't have to use my own capital for that. And I can strategically move that capital elsewhere. The other thing is with VFV, there is real estate, and I don't have REITs or anything. And the reason I don't have REITs, and I have considered REITs, is because I just want to go to the source. I will be looking at real estate in the future, and I'll just go right to the source and invest that way instead of doing the REIT scenario or the cryptocurrency scenario, I'll just go straight to the source because I have that ability to. And everyone's circumstance is different. Everyone's ideology of investing is different, and there's no right or wrong way. The ultimate reason I don't purchase ETFs other than VFV is because VFV is a broad market index that has the diversification in there, but it's not equal. When I don't have a problem with diversification, I have a problem with people diversifying for the sake of diversifying, because we hear it so much all the time. 10% in this position, 10% in this position, 10% in this sector, 10% in this sector. Well, why would you put 10% in a sector that's not performing? It just doesn't make sense to me. It just means more work for you. The only ETF I'm going to do is VFV. Any ETF that is tracking the index for the S&P 500, that's pretty much all I'm going to invest in. I know it's kind of biased in a lot of ways, but hopefully that makes sense. And so that's the reason why I'm not against diversification. I just don't like when people diversify for the sake of diversifying. It just doesn't make sense to me. Or someone says you need to put 10% in this sector, into this sector, into this sector. Imagine investing in a bunch of ETFs and you have overlap all the time. How do you combat that? So let's say you have the weighted ETF for banks, and then you have another index or ETF that is in insurance or banks, and they overlap. Now your position is a bit bigger than what you're trying to do when you're trying to diversify. It just gets into a big mess. And so I just like to keep it simple, pick individual stocks to beef up the positions in some allocations. And that's the way I go. So hopefully that makes sense. I'm not against ETFs. I don't like them. I don't like the ETFs outside that are trying to do something that just doesn't make sense to me. And the fact when I can go to the source to invest, I'll just do that. And diversification, it's not that I'm against diversification. I'm just against the principle of diversifying for the sake of diversifying. So hopefully that answers the question. A little bit longer video. Hopefully you guys did enjoy. And if you have any questions, leave it down in the comment section below. Don't forget to leave a like and subscribe. And we'll see you guys in the next one. Bye.